and our third segment on ESG strategy for corporates. So before we invite Mr. Vijay, let me introduce Mr. Vijay before he begins his sharing. So Mr. Vijay is a thought leader, an entrepreneur, innovator, and investor. He was the founder and CEO of successful energy companies and the first in Singapore to implement innovative and sustainable solutions encompassing ESG and SDG guidelines across the energy value chain. With over 42 years of overarching experience in the niche energy sector, Vijay had been at the forefront of the electricity market liberalization process in Singapore, encompassing all-inclusive energy management solutions on both demand and supply sides. So please join me in welcoming Mr. Vijay to share on this third topic. Mr. Vijay, please.
Good afternoon, everyone, and thank you very much for Aventis for providing me an opportunity to be part of this festival hub. And it's quite a privilege to speak to about 113 participants, though virtually. But I just want to distill some of my experiences and some thoughts and going forward plans on what actually ESG means. Coming out of my 42 plus years of industry experience, especially in the energy sector. Just as a preamble, since 1971, the human population has more than doubled. And since then, demand has gone rapidly for the Earth's resources. It is crops, fish, minerals, and energy. Humanity is currently consuming more resources than the planet can naturally replenish each year. We are now consuming the equivalent of a 1.75 Earths. We just have one Earth. This is absolutely unsustainable. We have overdrawn and we're overdrawing the nature's bank. It is time to pay back our nature debt. Then question now comes is, how do we do that? How do we define sustainability? Let's leave out the lot of jumbo nimbos and cliché phrases. Sustainability in a nutshell is actually a way of life. I call that way. What we do in our personal life, in our professional life, in our societal life, everything actually impacts the well-being of all of us as a civilization and also the environment, the only planet we have. With that, I would like to take you through some of my views about what actually ESG means and what are the things the corporates can do. And my presentation is sort of driven by the energy industry angle because I come from the energy industry. And that's where I would like to spend my next 30 minutes to take you through some of this very basic understanding about ESG rather than putting so many different complex charts and graphs. I just want to make this very simple to just understand what are the things, what ESG means to different set of people, and what are the criteria, what are the standards, and what can we do. Next slide, please. Next slide, please. ESG refers to three central factors: measuring sustainability and societal impact. Again, what I'm saying is as an investment in a business. Ultimately, every activity of our civilization revolves around the economical well-being of what we do. whether we invest right, or we spend right, or we optimize right in the business, in our personal life, and as a society as a whole. As we all know, historically, is a single bottom line financial concept. Anybody who has seen a financial statements of an organization or a company, there's always used to be a focus upon the profit at the bottom. And that was basically the key decision-making criteria for most of the investments or the economic activity. What returns, what profits the investments will bring in. And a decision related to the philanthropy or the CSR was something considered as not very good for the bottom line. It was considered as a drain on the financial performance or impacting negatively on the financial performance. However, with the advent of the climate change discourse going on for the last decade or so, and what actually the people are seeing now and the traction which is now getting from the impact investors or the social capital investors, there is a concept of social capital. It just does not really, it just effectively challenges the self-interest in the economic part of the business value measurement. So we are now looking at one step ahead. That effectively means just not the financial, but that includes environmental and social factors. And these combined together are now going to be providing a benchmark how the company is valued in terms of the investors, in terms of the consumers, in terms of their other stakeholders. So ESG, the third part of the ESG is governance, which actually gets intertwined with the financial and environmental aspects of the ESG, which I will take it in the next few slides. Historically, the corporate, sorry, it's a little bit slow. Oh, gosh. Historically, the corporate social responsibility, CSR, was considered as good or something like a good initiative. But this approach is now changed, as I mentioned before. There's something called a responsible investment or a social capital investment. New attributes like how the companies are managed, how the stakeholder relationships, how are the employees are treated, and now, and how is the corporate board level is functioning. These are all becoming part of a company valuation. It is earlier, as I mentioned before, that when philanthropy or CSR was taken into account, people say, oh, it has a negative impact on the balance sheet or the bottom line. But the studies have shown that in effect, it is opposite. Being an ESG compliant is actually improving the productivity and actually improves the corporate efficiency, because that actually helps resource optimization. So being an ESG compliant, one can build a positive reputation through transparency and accountability and not seen as just greenwashing. There's a lot of buzzwords on the greenwashing, which effectively trying to show that they are compliant, but they are not really compliant. It is just a jugglery. And that's where exactly a lot of efforts or the emphasis is now coming on how do we avoid the greenwashing. So uncertainty about what actually sustainability means and what are the ESG attributes are. There's a lot of information in the market, in the system. But issue right now is where the terms like go green, go echo before what the current trend of energy transition and ESG coming in. They're all significant gaps of understanding. And the momentum currently now is to bring the concept of ESG in a very structured and defined way, and bring that as part of the corporate culture and also investors' decision-making process. And that actually what is driving the ESG going forward. Okay, let me just dive into E part first. What is actually, we all heard about environmental issues, climate change. We are seeing significant temperature rises, ocean temperature rises, and what happened last week in Europe when unheard about 40.2 degrees centigrade in London. So climate change is a reality. There are different arguments for and against, but the reality is it is there. So what is more important is what the corporate is doing in its own operations to address the climate change, and what can it contribute to the sustainability. Sustainability is just not a short-term view, short-term bullet. It is to be taken as a long-term view, and especially in considering the emerging energy landscape. The Russia-Ukraine war has thrown the significant gaps in the energy security, energy resilience, and the affordability of the energy. And we are all seeing all over the world how the energy prices and the gas prices at the pumps and also at the homes and heating have shot up. And that's exactly where the emphasis now is how sustainable is our energy ecosystem. Then we come over to the social concerns, diversity. This is a very interesting aspect. What actually diversity means in a corporate life, in a corporate entity, attracting the right talent pool with a diverse and inclusive approach. So this is something called leveraging the benefit of the power of difference, because we need to bring in the talent with significant diversity, provide them the equal opportunities, and benefit from that diversity of the knowledge. Human rights. There are a lot of information floats around in the newspapers that certain companies, for their mining operations or for their timber operations or for the rubber plantation or XYZ, are not following the established or the United Nations established workforce environmental norms of operations or working conditions. That's something which is very, very important. And also, what is the impact on the local communities, the health and welfare of employees, and the broader society? Then there is a consumer protection. As you know, that just an example, what I would like to take is electronics waste. We are buying many electronic gadgets. We change one phone to another phone because new models come into the market. But what happens to those old gadgets? They go into the trash or they go into the waste bin. So consumer protection law is also very important. How do we really manage return of those old e-waste, we call it as, back to the companies for them to recycle? How are the consumers protected? Like, for example, another case happened is in European Union last few months back. They standardized the power socket for all electronic gadgets. I'm sure that all of us know in our houses we have multiple power sockets, because one time we buy one mobile model, another mobile model, another laptop that comes with a power socket and a cable, which is not compatible with others. Effectively, we're generating e-waste at our home. So to streamline that, it was also an important thing, and also for the benefit of the consumers, because we don't want to carry multiple power cables or the sockets. along with us when you're carrying with a few gadgets when you're traveling around or you're going to office to home or at home. So that's another part of the consumer protection. And secondly, how are the consumers' interests are protected? If consumer satisfaction, how are the consumers' complaints are addressed to? That's another area of being a social concerns. Then we come up to the last part of the ESG, G, governance. This is a very, very significant part. Actually, this is comes from, it should really coming from as a top to bottom approach. We need to have a clearly structured with roles and responsibilities defined at the company management, its board, shareholders, and various other stakeholders. That includes investors. Management structures. I mean, what sort of internal procedures and controls are now in place? And how is the management structure is put in place to help to drive the ESG narrative? And what is the balance of power between CEO, the board of directors, and the shareholders? Each one of them have a different objectives. If we have no common objective of running an organization at the CEO level or at the board of directors level and including the shareholders and the investors level, then we will never be able to achieve the ESG target where we want it to be. Because everybody's interests are different. So they need to be aligned. They need to be brought to one direction, one flow of thought. And that's where exactly the management structures and the stakeholders' involvement comes in the picture. Employee relations, as I mentioned before, the diversity and also the inclusivity in the decision-making process. Equitable pay for executives and employees across all genders. That's also becoming an important element. We always, there are a lot of things happen. We can see in the newspapers that the ladies tennis players get less pay than the gents tennis players in the Grand Slams. It is just one example, but it happens across every other economic activity. How are those issues being addressed? It's not the gender, it's the talent, it's the capability, it is a contribution. That's what actually need to be addressed to rather than just a male or female classification. Then the other important aspect is executive compensation. So interestingly now that most of the listed companies or even the non-listed companies now, where the investors are asking the companies to list or clearly identify what percent of levels of bonus payments and the levels of remuneration of the highest paid executives. Because there is significant disparity between at the top executive position compensation and then at the middle and the lower level. So what's the contribution? How are we going to, what is the basis for that disparity? These are the very, very important elements to be looking into as part of the governance. And of course, the listed companies have their own reporting requirements to the respective stock exchanges. And then the non-listed companies who are now actually being asked by the investors, private investors or the private equity or the venture, whoever the investors are, they are asking for a sustainability reporting every year on the ESG guidelines. So it is getting that good traction and it's in the right direction. So I covered the employee compensation along with the executive compensation. So it should not be seen as something like, okay, higher level and lower level and middle level, male, female. It has to be purely based upon the merits and the talent and then the capabilities. Most important thing is that the short-term strategies. Before the advent of the emphasis on the ESG reporting or the sustainability reporting, it was a short-term strategy. Just fix it now. No long-term views. But that's changing. So that's something which is being now driven by the third-party stakeholders, and also the understanding and the realization of the top management that this needs to be done for them to be surviving in the in the long term as an economic viable entity in their business. So now let's go back to the investors who are the key in driving the companies where they invest into carrying out the ESG side. What are actually the driving? What factors are driving these investors towards the social investment? We call it unknown uncertainties. With an emphasis on a short-term gain, many organizations fail to consider more balanced strategies and long-term risk management strategies. And example for is unthinkable what happened in 2 years back. We just coming out of the pandemic, COVID-19. It created a significant havoc in the business models of on every aspect of the economic activity, industry, F&B, transportation, hotels, leisure travel, everything. The business was not prepared. So these are called unthinkables and unknowns. So to ensure business continuity, we need to define what success is what we expect in the upfront. We can't be waiting for that to happen and then think what can be done. We need to be prepared and prevent such disruptions for the business continuity. ESG reporting and disclosure is now becoming a standard due diligence feature for investors. I was asked recently by a company. They were getting an investment of just $50 million. I'm just a small company, SME company. And as part of that, it was a big checklist of ESG compliance reporting, which in my experience before when I started my entrepreneurship back in 20 years, there was no such issues. The investor likes you, the investor likes the business model, Excel sheet, profit loss account, you get your money. But no more. Profit loss account, the cash flow statements are important. But what's the business model ultimately in terms of your ESG guidelines, ESG compliance? It is becoming an integral part of the due diligence for an investment decision by every investor, whether it is a private equity or a venture capital or the big boys, banks, institutions, even the multilateral agents, institutions like World Bank or ADB or IFC, everyone. So this investors-led initiative, which is basically enabling the sustainable financing. The financial ecosystem of demanding ESG requirements is focusing upon targeted lending. Regulation in certain economies are requiring ESG compliance. This is essential to deliver strong, sustainable, and balanced inclusive growth, addressing the SDGs 2030 targets and international climate change commitments. All countries are falling short. As I mentioned before, greenwashing. It was a lot of circularity was going on in how do you really define your carbon neutral or your sustainable. Those loopholes are being plugged now, are being tightened, and significant amount of clarity wise or bullet point wise reporting structures are emerging, and where there is a opportunity for the companies to showcase and inform the investors and provide and get the information on a very consistency and transparency and security in the sustainable finance market. It's become very, very important for a company to sustain its operations, because capital is the key for business operations. And without the capital, where the investors are now looking for significant ESG compliance, there's no business. But coming back to the ESG impact on the energy value chain, I mean, I come, as I said initially in my preamble, that I come from the energy background. I look at significant opportunities for what the energy market landscape will look like going forward. We're all used to a central generators hub and then the long transmission lines and then the consumer load points. Not much so in Singapore, but even in Singapore is the same actually, because all our power plants are situated in Jurong, in the west side, and all the consumption all over the country. So especially in large big countries, it is always the case. There is a centralized power generation, long line of transmission lines, and then the distribution centers and substations. That's not going to happen anymore. The solution going forward is off-grid and distributed energy. What it means, you take away the significant energy losses, environmental impact on the laying of the transmission lines, and then you also provide a local employment. That's also a part of the social well-being. Then there is a waste management, agriculture, animal and urban. Significant amount of waste in the biomass that can be used and tapped to bring renewable energy or renewable powers and support and reduce the fossil fuel consumption as part of the E of the ESG. Significant reduction in the carbon footprint, energy independence from fossil fuels, empowering the communities to manage their energy needs. This is important. In most of the underdeveloped countries or developing countries, it's so hard to find electricity supply and water supply. People need to travel kilometers and kilometers to get a bucket of water, and there's no electricity as well. And that's where we need to bring in new technologies, new solutions to support and empower those communities, and they become sustainable in their livelihood and having economic activities around that energy security and energy availability. So on top of that, healthcare infrastructure, it's very, very critical. So if we're really looking at three major buckets as a socio-economic impact attributes: energy, water, and healthcare. And all these things are getting as an integral part of the ESG narrative. So, where to begin? So, understanding from the top management that ESG is good for the business. That's important. It's just not that you're asked to do it because your investor is asking to do it, or some other stakeholder is asking to do it. The top management needs to be committed into this whole narrative. So that needs to come from them. And that positioning by the top management allows the initiatives to be driven down from the top and more buy-in from the wider organization. Provide more autonomy for the ESG compliance officer. If you're appointing an environmental officer or the energy manager or energy specialist, he has his own role and responsibilities. He needs autonomy. He cannot be dictated. He cannot by bottom or top that what they want to see. He needs to be given the autonomy in the organization as a compliance officer. Commitment must be embedded in the organization's business-wide strategy and operations. The ESG approach has to be an integral part of the entire well-being or the entire ecosystem of the organization. It's just not this bucket or this bucket or this bucket. It percolates. It just goes through every fiber of an organizational activity. But again, Can we do all of those things at one time? May not be possible. So we need to prioritize and focus on key areas. This is something like a 80-20 principle. So 20% of the activities could benefit 80% of the value. Then you provide a E&S management system through wider organization participation. It is a digital platform wherein everyone can participate and provide their inputs, and then also track and monitor the progress of each of those identified and prioritized focus key areas. How they're progressing and what are the inputs required and what are the next steps. So I would like to say ESG is not a race. It is a step-by-step approach. We can't just sprint to an end point. And it's actually a marathon. It's not a 100-meter race. So we need to take steps to make key improvements with an understanding that there is always a room for improvement. That's important to understand. One thing I have seen in my corporate life of 40 years, a change is always faces resistance. Status quo, perfect. Why do I want to do this? I'm happy the way it is going on. Right now it's fine. No, that's not the right approach. There's always a room for improvement. We need to get to that mindset from across the organization, that every step of the organization, every hierarchy level of the organization, there is a room for improvement. So if there's a room for improvement, identify a room for improvement, then we say, okay, I need to buy in my idea, my solution from my peers, my top management, my people under the line, below my line. So we need to, it is just not a one-man show. It is a corporate-wide collective effort. So organization must have a long-term view on ESG compliance. That's where the collective efforts, collective approach from top to bottom will make the company ESG compliant. That's where I finish my presentation, and